Welcome to RBC's Markets in Motion podcast, recorded July 13th, 2026. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, we're making several changes to our S&P 500 sector views, with upgrades to tech to overweight and discretionary to market weight, alongside downgrades of comm services to market weight and utilities to underweight. Second, the expected growth rate for 2Q26 S&P EPS has continued to drift up ahead of reporting season, but trends in beat rates and earnings revisions have been mixed. Third, on our broader outlook, we're on guard for a shift back into U.S. and mega-cap growth leadership. If you'd like to hear more, here's another 5 minutes. We'll start with takeaway number 1, our S&P 500 sector recommendation shuffle. Following last week's release of our quarterly RBC Analyst Outlook Survey, we are making a number of changes to our S&P 500 sector views. First, we're upping tech to overweight from market weight while lowering comm services to market weight from overweight. Reasons for the tech upgrade include strong upward EPS and revenue revision trends, inflows to the sector that are trending higher and bounced back after a week of steep outflows recently, and a positive performance outlook score among our U.S. tech analysts in the survey. Valuations admittedly aren't cheap, but in our latest update, the sector is only slightly above the long-term average on median absolute and relative PE. While the valuations in comm services look attractive on our work, we've seen a bit of weakness emerge in our EPS revisions indicator for the sector, and telecom flows, the closest proxy for the sector, have been choppy. Comm services also had a negative performance outlook score for the U.S. in our latest analyst survey. Second, we're upgrading consumer discretionary from underweight to market weight. Our survey revealed negative views on consumer-oriented sectors across the globe, including the U.S. compared to other sectors, and left us with the impression better performance would be a pain trade for investors in this area. While consumer confidence and sentiment survey data has been weak, there have been some signs of attempted stabilization, and consumer discretionary tends to outperform when consumer sentiment on the Michigan survey moves up. On our analyst survey, while our U.S. analysts gave the sector a neutral performance outlook score, it actually was a little better than the negative view of the Staples team. On valuation, discretionary is slightly above the long-term average on relative and absolute PE, and earnings revisions are also balanced. Overall, discretionary just comes across to us as a sector more deserving of market weight status than underweight status. And third, we're downgrading utilities to underweight from market weight. With the discretionary upgrade, we find we're in need of a new underweight sector. Utilities gets the nod for 3 reasons. First, it is one of the most expensive sectors in the S&P 500 on our model. Second, our U.S. analyst team had a neutral performance outlook for the sector in our latest survey, one of the least constructive views. And third, flows have been weak. Earnings and revenue revision trends are admittedly positive, but weaker than what we see for other sectors. In terms of other sectors we're watching, industrials, which were market weight, was a candidate for a downgrade given extremely expensive valuations and previously strong flows that have shown some signs of fading. But fundamentals seem solid as evidenced by strong EPS and revenue revision trends. Industrials also captured a positive performance outlook score for the U.S. in our latest survey for the analysts, despite a neutral view on their part on valuations. Meanwhile, energy, which were market weight, was a candidate for an upgrade, given the positive score from our analysts in our survey on all of the non-midterm questions, and had one of the stronger performance outlook scores. The sector also looks attractively valued on our model, and earnings revision trends are strong. What held us back is that funds flows for the sector are deeply negative. Let's move on to takeaway number 2, the signals from the early earnings stats. Bottom-up consensus EPS growth forecasts anticipate year-over-year growth of 24%, up a little from our last update. Among the early reporters for the S&P 500, the percent of companies beating consensus on EPS is up versus last quarter, but the percent of companies beating revenues is down. The rate of upward EPS estimate revisions for the S&P 500 has slipped a little, but what surprised us is that this stat has moved up again for the index's top 10 market cap names, and the softness we're seeing has actually been driven by the other 490 names in the index. Geographically, we are still seeing some improvement in European EPS estimate revisions, and Canada and Japan are also now trending higher on this stat. All of that has supported the geographical broadening trade. And we'll wrap up with takeaway number 3, why we're actually on guard for a shift back to megacap growth in the style trade that's ongoing tug of war. On higher level positioning trades, we indicated in our mid-year outlook update 2 weeks ago that the broadening trade, the outperformance of non-U.S. equities over U.S. equities and value over growth, probably had some room to run based on what we were seeing in our valuation work, but that we still thought of all of these as trades rather than longer-term shifts in leadership, given better earnings dynamics for megacap growth and a lack of follow-through for the broadening on funds flows. Our valuation work admittedly isn't sending a clear reversal signal yet, but given the sideways move in U.S. non-U.S. performance that has emerged recently, plus the return of growth value, high price momentum, low price momentum, and top 10 rest of S&P relative performance trends to levels close to past inflection points, we are on guard for a shift back into traditional mega-cap growth leadership. These are areas where we've seen the pivot before. Earnings season also presents an opportunity for investors to refocus on the better earnings story coming out of the AI theme in Mag 7 that remains embedded in consensus forecasts for 2026 to 2028. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.